Hi and welcome to the second lesson about investment funds. In the first lesson, we looked at investment funds in a slightly simplified way. In this lesson, we will look at more factors that affect investment funds and how they work. A real-life fund has a fund manager. A fund manager allocates the fund's assets. That means they decide when their money gets invested that the investors in the fund have provided. Now, they have the most crucial role in the entire fund because their decisions, where the money goes, decide if you make or lose money with your investment. So before buying in a fund, always assess whether you agree with the fund manager's investment strategy. To all the investment fund strategies, there are two overarching concepts: the passively managed funds and the actively managed funds. Passively managed funds are funds with a set strategies, a set of rules, and they have to follow them. So there's not much decision done by the fund manager in that type of funds. Now, the easiest and most common type of passive fund is the index funds or the index tracking funds. So let's look at the very simple index, the index AB, just a random index that's made out of two assets, A and B. And the index, to make it simple, says 50% of the index is A and 50% of the index is B. Now, imagine you have a passively managed fund that says we are going to track that index. So at time equals 0, their fund, let's say they have assets of 100, just to make it simple. So their asset allocation will be pretty similar, 50-50. Now, imagine though that at time equals 1, A has risen by 20% and B has risen by 40%. So that means that A is now worth 20% up from 50-60, and B is now worth 70, well, in that portfolio. So that means if you were to write down the new portfolio, it would look more like that, 60-70. And that is not conforming to the 50-50 rule. So in that case, what the fund will do is they will sell 5 of B and use that money to buy 5 of A. That's a very ugly 5. And that means they will go down to 65 and 65. Now, those adaptations are usually undertaken 1, 2, or 4 times a year. So either every quarter, every half year, or every year. Actively managed funds are a lot more complex because they have a smaller set of self-imposed rules. So the fund managers and their subordinates have a lot more research to do, but that means their asset allocation is also way more up to them. And that's what I meant when I said that you should research a manager before investing in a fund, especially with an actively managed fund, because if you don't see eye to eye with a manager on his investment strategy, then the fund will probably be wrong for you. Otherwise, the fund will be right for you, obviously. There are, generally speaking, 3 types of expenses with a fund that apply to at least all funds, or most of them. The expense ratio is the first one, and that one is just a small percentage of the fund's total assets that are charged annually in order to cover some operational costs, like the employee's wages, the fund manager's bonus, and all of that. Now, the expense ratio is typically higher for an actively managed fund, because active funds need more research, so the employees are paid more and there's more employees and so on. So passive funds will be about 0.2% and a bit less, and active funds go all the way up to 1.5, at which 1.5 is already considered quite high. So let's write 0.2% to 1.5%. The front-end load is also a percentage, but the percentage of your initial investment that is charged when you invest in the fund. And that ranges typically from 2% all the way up to 4%. So imagine if you have a 2% front-end load on a fund. That means if you're willing to invest 100 with them, you actually pay 100 out of your pocket. You go away, but you only get 98 worth of assets. So that means the difference of 2 out of 100 would be the 2% front-end load. The redemption fee is slightly similar to the front-end load, but it happens at the end, so when you get your money out of the fund. Now the redemption fee is typically 1% to 2%. So same concept. Now imagine you have 200 invested, or the assets you own in the fund are worth 200. But if you want to get the money out, and there's a redemption fee of 2%, that means even though you would actually own 200, you only get 196. And the full difference, 4 out of 200, would be 2%. Funds can specialize in many different types of securities. So funds could go from high yield corporate bond all the way to government bonds, all the way to real estate, to gold, to stocks, to junk bonds, like anything basically. But what is important to remember is that when you buy funds, you want to diversify a bit across the funds, as I explained in the first season when I talked about risk management. So some funds contain many different types of securities. Some funds contain securities from different countries. Some funds have the securities really limited. So some funds will just focus on one single country, a small country, and only stocks. So that would be a very large risk because either the economy fails there or anything could happen. But if you diversify, so you could buy total world funds and they specify in stocks but from all around the world, and that would be less risky. So really the key thing to remember here is that funds can diversify across all types of securities, and it's up to you to make a portfolio out of it where you think the diversification is enough. Thank you for watching this lesson all the way to the end. I would very much appreciate it if you shared it, and I'll see you very soon in the third lesson about investment funds.